So now with this understanding of the price, volume and time relationship, we have established that we should be participating when price is moving on back of high volume across the time frame that we are examining. Let's now discuss a framework that will help us identify the right time to participate and the right time to sit out of the market. So for that, let me introduce you another person, Mr. Stan Weinstein. So he is the author of the book The Secrets of Profiting in Bull and Bear Markets. It's another must read that you should add to your library and read it as soon as you can get your hands on it. So in this book, he gives us an excellent framework for timing our investments and trades in the market. He says that there is an ideal time to buy and an ideal time to sell in order to make consistently profitable returns in the market. Using his methods, you can shortlist the technically strongest stocks and also spot the overall market cycle to ensure that you are participating when the odds are in your favor. So thus this overall increases the odds of our success. So his method is called Stan Weinstein's stage analysis. So Stan Weinstein's stage analysis offers market participants a powerful tool to identify current market trend and to make rapid adjustments to entry and exit strategies and risk management practices. Okay, so basically what he has done is broken down the market structure into four stages, and he has showed us how we should be analyzing the market and or the price action to understand which stage the market is in, and then according to the stage that the market is in, we should take appropriate action. So the market stages. The market can be in one of the four stages. Stage 1 accumulation, stage 2 markup, stage 3 distribution, stage 4 markdown. So over here you can see that stage 1 is a basing stage or the accumulation stage. So prices are generally in a balance, and this usually is formed after a market decline. So over here you have the 30 weekly moving average, which is basically a moving weekly average of the price over a 30-week period. Over here we can see that the 30 weekly moving average is sloping down. That means that price over here is coming from a corrective period. After some time of correction, it forms a stage 1 accumulation area, and then eventually price starts moving up, and eventually it crosses over the 30 weekly moving average. The 30 weekly moving average also over here was flat, but as this begins to rise and price also begins to rise, we can say that we have entered stage 2 or the markup area. So stage 2 can continue for some time, where price continues to move up, form new bases, move up, form new bases, and eventually it flattens out. And the 30 weekly moving average line also starts flattening. So this stage is called the stage 3 or the distribution phase. After this, price, in case it declines, then the 30 weekly moving average also traces the price, and we can say that the price enters stage 4 or the markdown phase. Sometimes what happens is that after stage 3 price continues to move up, so it enters back into stage 2. So basically at any given time the market has to be, or the stock has to be, either in stage 1 or in stage 2 or in stage 3 or in stage 4. And using the 30 weekly moving average line as reference, we can identify in which stage the stock or the sector or the index is. So let's discuss the chart setup that we require to do stage analysis. So first thing, the stage analysis is always done on the weekly time frame. Over here you can see this is the weekly chart of ICICI Bank, and then we require three indicators. The first one is the 30 weekly moving average, which is the moving average line on the weekly chart and over a 30-week period. So this gives us, at any point, gives us the average price over a period of 30 weeks in the past. Then you have the volume indicator. So over here you can see this is the volume indicator. This helps us identify the quality of the breakout when price moves from one stage to another. Then we have the relative strength indicator. This is basically comparing the strength of the stock when compared with the benchmark index over here, which is Nifty 50. So if when the RS line is rising, that means the stock is doing better than the index. But when the RS line is declining, it means that the stock is doing worse, or the index is doing better than the stock. So we actually want to be in stocks where the RS is rising. That means the stock is outperforming the benchmark index. So once we have these indicators on the chart, then our job is to mark out the stage areas. So let's just do this once on a chart, and then we will discuss further. So here we have the TradingView platform. I'll just refresh it. Once you are on TradingView, you can sign in and set up a free account. With that, you can access the basic features that we need. So you go into products, go to charts, and here it by default opens Apple. You go to ICICI Bank. So you can just click here and put ICICI Bank and then select. And this is as you can see, this is a daily chart, but we need a weekly chart. So you can click over here and select 1 week. So this is the weekly chart of ICICI Bank. And now we'll start adding the indicators. The first thing that we need to add is the moving average. So we go to indicators and we go to moving average. Yep, this one we select. So by default, so see a blue line has appeared and then we have to go into, by default, this is a default setting. We need to change it to 30 period weekly moving average. So we go into settings, go into inputs, change the length to 30, go into style, and let's change the color to red and make it thicker. This is the moving average that you're looking for. Next, we'll add the volume. Go to indicators, volume. So now we've added 2 things. Now the third thing that we want to add is you keep getting these pop-up ads in the free version. Now we need to add the relative strength indicator. So that is not there by default. So I will share with you the code for the relative strength, which you can just copy paste once. So to add the code, what you have to do is go to Pine editor and just delete this, and 1 second. This is the code. I will share this in the description under the video, and then once you've added, I can change it to relative strength, save, and add to chart, and you can minimize this. So see, so the relative strength line, which is basically comparing against Nifty 50, has been added. We can increase the thickness if we want. So over here we can see a rising relative strength line. So now that our chart is set up, now the task is to basically mark out the stage areas on the chart. So you have to remember two basic things. Buy when stock sector or index are in stage 2 uptrend, sell when stock sector index are in stage 4 downtrend. So these are the 2 golden rules. You have to only participate in a stock when it is in a stage 2 uptrend, and you have to either sell or not participate in the stock when it is in a stage 4 downtrend. So let's identify the stage areas here. So over here you can see the 30 weekly line, moving average line was downward sloping, and eventually price flattened out in this region. So this is can be marked as stage 1 because it is formed after the price has moved lower. Then over here finally price moves above stage 1 and the 30 weekly moving average line also starts to rise. So this can be marked as the start of stage 2. Then there is a pullback, but the 30 weekly line is still sloping upwards and the price continues to move up. So this is stage 2 continues. And then eventually as the 30 weekly moving average line flattens out, price also flattens out and it forms a new area of balance at the top after stage 2, and this can be marked as stage 3. So if price now breaks out again, we can say that the price has again entered stage 2, but in case the price moves down and the 30 weekly moving average follows, we can say that the price has entered stage 4 downtrend. So we only participate in these areas. This is the area where we want to participate in, and not in this, neither in this. We'll discuss this more in detail going forward. So over here I have one more example, and we will see, actually I wanted to show you the power of stage analysis and how we can use it to catch stocks that are in multi-year bull runs, and what we can also call a multi-bagger stock. So we'll try to analyze this stock called Bajaj Finance. I'm sure most of you are aware of the company, and so we will start from 2011 and then we'll kind of track its progress over the next 10 years. Okay, so let's start. I haven't marked anything on the chart, so we will do everything as per stage analysis technical checklist. So we are right now assuming that the stock fundamentals are strong. It's in the growth stage, and it's consistently doing good numbers, both in terms of sales growth and in terms of quarterly growth. And we know that it has a very high quality management, and it's a fundamentally strong stock. Okay, so let's start. So we are in 2011, and if we are looking at the stock somewhere here, we will mark this high and then watch, then this low, then we get another high, low. So basically we are able to figure that in 2011 full year the stock stayed in a range, and we can mark this as a stage 1. Okay, now finally it broke out, and you can see this rise in volume and this wide range candle. Right now the stock would be at a 52-week high point, which is a great plus for us, and this is the all-time high, which is I think somewhere here. So if the stock is actually able to cross in the all-time high as well, then that means that we might have caught a very good stock, and it will trend well. Then it continues to hold above the, so this is our low that we will be tracking, and this is where we've entered. So it makes a new high, then this is the low point, and then it finally breaks out another wide range candle out of the all-time high. Then it makes a new high, then it just takes support at the previous all-time high level, and continues to move up. So over here, after this candle is formed and then the price is able to make another new high, we can say that over here we have moved into a stage 2. Also you can see here that the 30 weekly moving average line had started to trend up, and also the relative strength line is trending up. I think I'll use the, it's also trending up. So this is important. All-time high levels, stage 1 into stage 2. The breakout candle had good volumes compared to the previous year. So all our all our checklist points are met. So we will build, if we have built positions or we have been able to build positions, we will now stick with them and we'll trail them accordingly. So the move continues, new high, new low, new high, and then it moves below the 30 weekly moving average line here, but as you can see it has not really flattened out here, but we'll still mark it equal high, this is the low, and then this is the candle that violated this low, and we would exit over here. This is an exit. So this comes at about 125 and we had entered at around 71, 72. So that's a decent, about 50-60%. Almost 80% move that we were able to capture. Then after some time we see that the stock quickly moves up, but we will not participate here because the 30 weekly moving average is kind of flattish only, and we would want a proper stage structure to form. So once this happened, it then moved back down and tried to go into stage 4, but it's very quickly found support. So it was just a small, just 2-3 weeks of excess that it created, and then it eventually formed this stage structure. Then again, this is another wide range candle that came out, and then eventually when the trend of 30 weekly moving average also turned up above this point on this wide range candle, we could have entered the stock again, and here you can see the volume started increasing and the slope of RS was up. So this again, from stage 3 we again entered stage 2 at around, this is 160. Now let's move on to see where it, so we are right now in September 2014. So this is where we had marked September 2014 is somewhere here. We had marked 160 level on this. So I think we entered on, yep, this candle which was above this. This candle at 160. Then you see this, it's formed a very smooth stage 2 where it hardly tested only once. So from 2014 up till 2016, and then finally in 2000 September 2016 it violated the 30 weekly moving average, and we can exit here because it formed a small stage 3 structure. We don't know if it will go further down, so we want to protect our profits, and this is the point where we would have exited. So from 160 to about 960, so that's 800 500% move, so that's massive. So that's almost 5x. Now going forward, let's see. So this we have exited and we have marked this all-time level because immediately after that the stock started moving up again and the 30 weekly moving average also picked up. So this area can be marked as a stage because stage 4 didn't develop, so this becomes a stage 1, and then because the slope of the 30 moving average did not flatten and it was still trending up, and the RS was also trending up, when we found these wide range candles 1, 2, we could have entered again. This is very close to where we had exited, so now we enter again and we expect stage 2 to continue, and if stock is able to break this and move into all-time high, then that's even better for us. So let's move on and see what happens next. So this is about 2017 May. Okay, so 2017 May, yeah. So this is where we had entered this point, and after that we see that it makes a low, but over here this is finally where it starts flattening out, but this low was never violated, so we hold our positions here and then we move back up, then a new high, new low, new high, new low. These were some lows in between, new high, and then this low was finally violated during the COVID fall. So maybe seeing this white candle we would have exited a bit, but anyways, even if we had exited here, this is about 3000 from an entry of about 980, so that's another 300% move. And then now that we know how to track, so this is another stage. Here we will not enter because the 30 weekly moving average is sloping down, and then finally over here it started moving up and we got two candles and another stage 2 in the stock started. So that's basically how you can catch stocks that are in the growth stage and and have the potential to become multi-baggers. So you might not get like one smooth uptrend. You might enter or exit them 2 3 times, but over this period also you would have been easily make about 10x on your total on the capital that you would have deployed. Now, after we've set up the charts, we have to look at the tech. Let's discuss the technical checklist, the things that we need to see before making an entry or an exit in any stock. So, first thing is that we have to only look for high liquidity stocks. These are stocks which are within the Nifty 50 index or the top mid cap or small cap stocks which are also within the index. Basically, the top 2 300 stocks where liquidity is high and which are tracked by a lot of other institutions and traders alike. Also, you can look at IPOs which are recent from 1 to 3 years. These are companies that are in their growth stage, and if you are able to catch something here which is in stage 2, they generally tend to do very well. Second thing is the 30 weekly moving average line should be rising or starting to trend up. We only have to participate when 30 weekly moving average line shows a upward slope. Third, relative strength should be rising compared to the broader market and sector. Stocks should be outperforming the market. So we only want to participate in stocks that are outperforming the broader market. For this, the best tool to check is the relative strength line. And in case it is rising, that gives us confirmation that the stock is actually outperforming the broader market. Volume should be high at the breakout and the breakout candle should be wide in range. This we had discussed earlier. We need a wide range candle which is supported by high volume, which shows that the underlying move is coming on back of strength. Limited overhead resistance. Stock should be on the path of least resistance. This I'll show you in one of the examples. Prefer stocks that are moving in all-time high and 52-week high zones. So you need to look at stocks that are near all-time high or 52-week high. How this helps is that, see, I will explain this quickly. See, a stock that is moving up, so this supposedly is the all-time high zone. So anyone who has bought the stock along here, or maybe here also, they're all sitting on profits, right? So it's very difficult to make them sell. So that means that there are very few sellers in the stock. So a stock that has been trending up generally, anyone who has bought it as it has anyone who has bought the stock along the way is sitting on profits, so they are strong holders and not weak holders. Whereas if you look at a stock that has was trending down and then has turned up, now any people who bought the stock here, they were all sitting on losses till the point stock retraced to their levels. And this is where psychologically also, if you think, these people tend to sell their position either at break even or at little loss. So this kind of attracts sellers into the market. So it makes very difficult for price to move through these areas where a lot of sellers are sitting. That's why you want to be in stocks that are at 52-week high, all-time high, where there are no sellers and everyone who's holding the stock is sitting on a profit. So here is an example. Here is the typical setup and how it plays out. So here we have a stock that is in stage 1, and then this is where the breakout happens. The breakout, if it is on back of volume, we will take an entry. Then, as we had discussed, the stock moves by forming highs and lows. So this is the so initially when we it moved up, I'll just use the yeah. So this is our entry and this is our level to mark as a stop loss. So this is a low and then it forms a new high and then the stock forms the first base. So base is basically short term accumulation where or a pullback where price either moves. So a pullback is basically where a price either moves down in a downward sloping channel, so it can move up and then it can move down, then it breaks out again, or it's where a price can either move sideways. So this is a downward sloping base, this is a sideways base. So over here we have a sideways base, and what it does is it gives us a new higher low and then price breaks this out. So as an investor, this is the ideal spot for us to enter when the transition is happening from stage 1 into stage 2. And as traders, a lot of people track these bases and then they enter on the break of these bases to capture basically this trend, to capture this trend, or maybe this trend. Okay, so right now we are trying to capture the entire trend. So this is the ideal entry. Then we move up, then 30 weekly moving average line is continues to trend up. We come down near the line but we do not violate the line. Then we move back up and we form another base and then a new high. So this is the high, this is a new low which is higher than the previous low, and the stock continues to move up. Then we form a new high, then we form a new low which is just slightly below the 30 weekly moving average line. But since the slope was up, we do not look at exiting. And then price quickly retraces back up and then it moves up again, forms a new high, then it forms an equal high. And this is maybe the first sign where we should be a little careful. Then this is the low that it forms, and then eventually it violates this low, and this is where we exit the trade. Because over here we know that the structure is now changing and the price from here moved into a sideways trend, and now which is now violated by forming a lower low, and we do not want to be in the stock when it is in stage 4 downtrend. See, the 30 weekly moving average line also flattened out here. So this with an equal high and a equal low here are signs that the trend has changed from a stage 2 to a stage 3 and we should be looking for our exit. So here this is the first base, second base, third base, and then fourth, fifth bases within stage 2 advance are much more prone to failure. So watch for warning signs, which were very clear over here. And then on the violation of this, we exit the trade. 30 weekly moving average starts to lose momentum. Tactic changes to aggressive stop loss placement. Don't raise your stop loss until price moves back near the prior swing high of the most recent advance. So this low is only valid when price moves above this high. This low is only valid when price moves above this high. This low is only valid when price moves above this high. So once it moves into a new high territory, we can mark these lows and trail our positions using these pivot points. So here is an example of Maruti Suzuki from 2012 to 2014, we can see that the price did not do much and we were in a stage structure. This is where I would mark it. And then finally, on back of these two high volume wide range candles and higher volume, price moved up into stage 2. Then it formed a higher high, higher low, higher high, higher low, higher high, higher low, then two equal highs, and finally it broke the 30 weekly moving average line. So if we had entered here, this is where the stage shifted from 3 to stage 4, and this is a valid exit. Then it moved back into stage 1. We do not buy this breakout because the 30 weekly moving average here is trending down. We wait for the line to trend up and then we buy on back of this wide range candle as price moves up. And if you can clearly see here that the volumes are very strong. Then we get back into stage 2. We test out the 30 weekly moving average, but there's nothing to worry here because we are in a stage 2 and these pullbacks are very normal. All it does is it forms a new pivot for us to trail our positions. Then we move up, new high, new low, new high, new low, new high. Then still this low is higher than this low, but then it eventually forms an equal high. And then once this breakout happens, this is our exit. So you can see this, and then once you exit and the stage 3 is broken, then we enter into a stage 4 downtrend where this is a lower low, lower low, lower low. So you see here how this plays out in this actually played out in Maruti, which is probably a sector leader, So if you are able to capture these moves, you can actually get significant returns. So this is somewhere around 2000 and the exit only came around around 4,500. That's more than 100% move. And over here the entry is around 4000 and the exit actually only came about 9,000. So that's also almost a 150% move. Let's look at another example. So this over here we are tracking the IT index, right? So this simple state structures also work on the indices and the sectors. So if suppose I am looking at a stock within the IT sector, I would also want to check if the IT's overall sector is in stage 2 or not. Because in case the sector is also in stage 2 and the stock is in stage 2, that increases the odds of success in my favor. So over here we have the IT sector weekly chart, and this is 2020. This is the COVID fall, and after the fall you can see the IT sector was one of the first sectors to break into all-time high zones. So this is an all-time high zone. You can see that the price is above 2019 2020 high, and this is where everyone who's bought into the sector, they're all sitting on profits and no one wants to sell. So this is a very strong position to be in. So the stock actually moved into stage 2 when the 30 weekly moving average line turned, and we can mark this wide range candle as the starting point for stage 2. And then we continue to move up, made a new high, made a new low, new high, new low. Then we formed a temporary stage 3 where equal highs were formed, but we quickly moved into a higher low, and then the price made the higher high, higher low, and then continued to move up, made another higher high, higher low, higher high. But this is where the previous low got violated, and we also moved below the 30 weekly moving average, and eventually the sector turned. So if we are participating in the sector, this is our entry and this point is our exit. Okay, let's take one more example. So this is Nifty 50 on a weekly time frame. So now we are analyzing the entire market, broader market. So this is again the COVID stage 4. 1 second. After that, we formed a stage 1, and this is where the 30 weekly moving average started trending upwards. So this is our first wide range candle, this one. Then another two more wide range candles. So this marks that the stage 2 has started. So if we are looking to buy any stock within the Nifty 50 index, this is a good time to buy. Eventually the stock moved into all-time high zones over here, which actually led to a very strong stage 2, and then we formed a higher high low, then over here, higher high, higher low, higher high, higher low, and 30 weekly moving average was smoothly trending up and was never even tested once. Then eventually, if you see here, in sometime in December 2021, we formed a new high. Then price came, tested the 30 weekly moving average, formed a new low, then actually formed a lower high, this high and this high. So this high is actually lower than that, and then eventually this low was also broken on the downside, and this is where we can say that the trend is changing. So if we had any positions here, this is where we would start exiting, and you can see here the 30 weekly moving average line also started to flatten out. So now we can mark this as a stage 3, because price actually made, after this price made, this is just a little offshoot, but then it quickly moved back in. So we can see here that price made equal lows for some time, and this is a downward sloping kind of a line. So this is stage 3. So in case price now breaks below this, we can say that we are in stage 4. But in case price continues to move up and breaks on the upside, we would say that we are back into stage 2. I think one more example I have. Yeah, so this is InfoEdge or Naukri.com, and this is an example from 2001 to 2014. So I wanted to show here that price can stay in stage 1 for a very, very long time, and the longer actually the better. That means that the base is much stronger, and the move that comes out of such long bases is also very strong. So actually over here it stayed inside this range from 2010 end till up to 2014, and then finally when the breakout happened on, so over here you can see one wide range candle, another wide range candle, another wide range candle, and we can see that, see, look at this volume, and then look at these strong candles, green candles, on which actually the breakout happened. So this is a strong breakout on back of good volume, and then the price moved up into stage 2. So this is a high, this is a low, this is a higher high, this is a higher low, higher high, higher low, higher high, then another higher high, higher low. This is where the price actually for the first time violated 30 weekly moving average. This is a lower high. This would tell us that okay, maybe we have to keep an eye out now. This is the first time this low was violated, and this also marks our exit, as the 30 weekly moving average line had also flattened out. So eventually we basically entered here and exited here, but this formed a longer term base once more, which is stage 3, and then eventually it broke out again with wide range candles on back of good volume, and price continued to move up in stage 2. So we've now covered the fourth part, that is perceived value or technicals. And by now, I think you would understand how the supply demand economics play out in the market, and why it is very important for us to only participate in those stocks that are in high demand. Also, you would have learned how to identify the supply demand shifts as they play out in real time using price charts and candlesticks, and how you can use the stage analysis framework to time your entries as well as exits. Now, going forward, we'll try to put everything together to develop a system to manage our portfolios.